Hi, everyone. Welcome to a collaboration between the Savant Report and Bar Chart. My name is Jordan Wirsz. I'm going to be your host today for today's discussion, talking about the potential for a lengthy or lengthened crypto winter as it relates to the current economic backdrop and inflation, which is running very, very hot. Just to give you a little bit of background on myself, I'm a career investor. I've spent 22 years as a professional investor and allocating not only my own capital, but that of my partners as well. The vast majority of that time I spent in commercial real estate development and investment. But just as of a couple of years ago, I became very, very passionate about crypto, about Bitcoin, and really started taking an active role in learning and growing my knowledge base. But not trading so much as investing, but I will tell you that my investment activity in the crypto ecosystem, not just Bitcoin, not just the tokens, but specifically in venture capital and private equity, has been very, very big. So I've spent a good portion of my time, many hundreds of hours, probably thousands of hours, studying not just the charts, but macroeconomics as it relates to these things. Before we get into the bulk of what I want to talk about today, I want to give you this disclaimer. Disclaimer regarding investment decisions and trading. Decisions to buy, sell, hold, or trade in securities, commodities, and other investments involve risks that are best made on the advice of qualified financial professionals. I am not one of those, by the way. So let's dive into kind of my thoughts and my thesis here on what is to come in the crypto winter. I'm going to bring up just a chart here from barchart.com. This is a weekly chart of Bitcoin going back approximately 5 years. And the reason I'm bringing this up is just to show you the massive scale at which the 2021 and going into 2022 bull market gave us. Like, this is such a big, giant super cycle kind of event here. And I'm not going to say that it's unwarranted. I will tell you, I'm a traditional market guy, and I've never looked at markets on a logarithmic scale. But when you look at Bitcoin and Bitcoin's massive adoption and the price movements on a percentage basis in crypto, really the only way to effectively look at crypto is on a logarithmic scale. And I have to tell you, in fact, many charts just automatically revert to logarithmic because it's the only way that they can actually show the Bitcoin or Ethereum or any of the other alt tokens, in a scale that makes sense to the human eye. But here's what I want to talk about today is the effect of the inflation that we have going on right now and the macro backdrop on what could potentially be a very ominous multi-year bear market or crypto winter for all of crypto assets. Now, I have to tell you, I'm not here to make specific price predictions. I don't want to talk about the idea that I have all the answers. I don't think anybody has all the answers, but we can take very relevant information and we can take the macro backdrop and we can put it into a framework that most of us will agree is a pretty reasonable thesis, a common sense thesis. So let's talk first about inflation. We just printed a 9.1% year over year inflation rate for the month of June 2022. That compares June of 2021. And 9.1% is the highest rate of inflation that we have seen in 41 years. That is massive. That is a big deal to the average person. But let's talk about why crypto started running in 2020 and 2021 to begin with. If we look at this chart, you can see that really about April, May of 2020 is when Bitcoin in specific really started to launch out of its base and head into, higher highs here. This is, let's see here. This is where my cursor is right now. That would be the capitulation wick in March of 2020. We saw, April, we started to kind of increase, and then May, we took off, and ultimately in September-ish, we broke out of this range and started running October, November, and we just saw a massive run up here into the May-ish months of 2021, and that was our first peak at 64,000. Now, we had a very big correction. Everybody was presuming it was a bear market. And then we saw a giant big run up to 69,000. But what started all this? What was the event that ultimately culminated in the start of this bull market? The event was very, very simple. It was easy monetary policy. It was money printing on a scale that we here in the United States and America, we have never seen before. We printed trillions and trillions of dollars. And we also did something that we've never done before on scale or in scale, which is dump money into the hands of every American to spend however they wanted to spend it. I can tell you that that had massive implications in all of the markets, not just stock markets, but particularly crypto. That was discretionary money that was dropped in the laps of many people that didn't need it. And at the end of the day, they took a lot of that money and began speculating. Now, buying begets buying, and bull market activity begets more bull market activity. And we saw that happen with Bitcoin. And we saw it happen with crypto, and we've seen it to some degree in many other markets, from real estate to equities. Commodities are a little bit of a different thing because they are supply and demand driven, but we saw those rise because of not just demand, but we saw massive supply constraints. And we saw, supply chain issues across the world, and that pumped commodities in a way that most people never thought or imagined possible. Lumber like 5x'd in a matter of just months. Home building became very, very expensive. That drove the real estate market up. People wanted to move out of metropolitan areas and into the suburbs or into more rural areas. That drove real estate in rural areas across the United States. We saw this big, massive bubble. So monetary policy and money printing has a lot to do with the price of speculative assets, and that specifically includes Bitcoin. Now we find ourselves in the exact opposite situation. The biggest tool that the Fed has to fight inflation is interest rates. They raise interest rates, they make borrowing more expensive, and when they make things more expensive, typically it curbs demand. What the Fed can't control is the supply side of the equation. They can't fix the supply chain crisis and those problems. Fortunately, those are beginning to work out as we speak. But 9.1% inflation is nothing to scoff at. That means that things like fuel and energy has gotten much more expensive. That means things like food and food inflation are now crazy expensive compared to where they were a year ago. Very, very expensive to where they were just a couple or a few years ago. Housing and the cost of housing has gone up substantially. And so, it's really crimping the average person's ability to speculate and to even buy assets that they believe in long term, like I believe in Bitcoin. And so where does that ultimately leave us now? Well, we're raising interest rates. We're tightening our monetary policy. The Fed is actually unwinding their easing, which is called quantitative tightening, or QT for short. And now we've seen ourselves change from a cyclical bull market in all assets, really, to a cyclical bear market in a lot of assets. So let me name off a couple, okay? Not just crypto, not just stocks and equities, not just commodities, but we're watching all kinds of other assets unwind. We're watching used vehicle prices start to crater here in the last couple of months. We're watching housing demand really diminish to a huge degree. So real estate is starting to come off. We're looking at artwork. The price of artwork is starting to come off. The price of gold and precious metals starting to come off. Now, those are not just commodities that are used for, productive things, but those are hedges against inflation. And we're seeing all of those unwind here right in front of us because of a change in monetary policy. So when we have these cyclical changes, and I'm hesitant to say it's something more than cyclical, I don't necessarily want to say it's secular bear market, at least at this point in time, but we're looking at potentially a couple of very rough years in front of us. In order to get inflation back in line, the Fed is going to have to crash the markets, which they've effectively already done, and they might have to do that and sacrifice higher unemployment rates. So we haven't yet seen a big increase in unemployment. Now, if companies start to lay people off and companies are not hiring like they once were, we could see unemployment begin to tick up, and that's where the Fed is put in a very difficult position. The Fed has two mandates. By the way, neither one of those mandates are to prop up markets and make sure that the economy stays out of recession. No, in fact, far from it. The two mandates that the Fed had is number one, to maximize employment, and number two is to keep a 2% inflation target. Well, at 9.1%, we're something like 4.5, almost 5 times the Fed's inflation mandate. So they have to over jawbone the market. They have to basically force us into recession. They have to create demand destruction in a lot of these markets in order to create so much destruction on demand. We'll probably enter recession, and they're going to raise interest rates to probably the greatest degree at the greatest pace that we have seen in decades. And when all the carnage is laid out, when it's all out there in front of us, they're going to say, hey, inflation is now somewhat under control, but now we have elevated unemployment. So we're going to even things out a little bit, maybe by beginning quantitative easing again and maybe lowering interest rates. That cycle is going to take a minimum of the next 12 to 24 months. It takes time for these things to work out, work through. A lot of these indicators that the Fed and that the economists are looking at are lagging indicators. That means that a lot of times the damage has been done before they find out that there's been any damage done. Unfortunately, the Fed doesn't pay attention to the real world signals that people like you and I see here on a day-to-day basis. So as we look at the Bitcoin market, we're sitting here looking at this massive cycle that we've had run up. We've set new all-time highs at 69,000. We're now trading right here at about plus or minus about just under 21,000. We'll call it 20,000. We saw a low of about 17,500. Percentage-wise, Bitcoin was down about 75% from its all-time high to its now cyclical low. I believe that this crypto winter that has been created by these changes in monetary policy and also by the leverage in the system. We've seen hedge funds like Three Arrows Capital go bankrupt. We've seen DeFi platforms like Celsius go bankrupt. We've seen a lot of leverage, a lot of big shoes to drop, almost kind of that Lehman moment for crypto or that .com moment for crypto. So a lot has come out, a lot of damage has been done. This crypto winter is going to hurt a lot of people. We had peak numbers of eyes looking at the cryptocurrency markets. It was a daily reported story on CNBC. And when you start to unwind that, when you take that kind of damage and destruction in a market, it hurts people's feelings. And that bias is that people don't want to touch it. They remember how absolutely destroyed they were when Bitcoin went from 60,000 to 20,000. And keep in mind, a lot of those retail investors bought at the very top. And so a lot of people are just going to wash their hands from it and wait to see what happens. Meanwhile, all these other narratives are going to flood in their minds. We've got inflation. We've got housing starting to roll over. We have a potential recession. We have unemployment increasing. Their groceries are more expensive. Their gasoline's more expensive. Their house value is declining in value. The last thing that they're thinking about is speculating in crypto. And crypto is a very speculative asset. I cannot underscore that enough. And so it's very possible that the damage and destruction that has been done mentally and emotionally to the retail investors that were the big parts of this big super cycle move up in Bitcoin that we've seen, very possible that it takes them a year or two for those emotions to heal. In fact, I saw a statistic that said it actually takes between 13 and 18 months for those emotions at the bottom of a market cycle to dissipate and for people to be open-minded again to becoming optimistic. And so if that's the case, we're talking about a year away, year and a half away. This crypto winter could very potentially and very likely will last into next summer of 2023 before things begin to get bullish enough for people to enter the market again. That would put it on pace to be one of the longest crypto winters. If we take May 2021 as a high, or if you want to extend that out to November of 2021, that would put this cycle, this crypto winter, if you will, at almost about 2 years. Now, remember, the Bitcoin halving cycle is really important to the price of Bitcoin and to the crypto markets in general. And the Bitcoin halving cycle is supply to miners, anyway, the rewards get halved every 4 years. Now, the next halving is scheduled for, first half-ish, first quarter maybe, of 2024. So we're really going to be bumping up against that halving cycle, and that is another reason potentially to get bullish later into 2023. Only time will tell how these markets react. I think we're overdue for a bounce here. Very possible that we get one. I would not say that a bounce is going to be an indication of the start of another bull market. It's simply a bear market rally, and that's very typical of markets and how markets trade, just generally speaking. So that's kind of my overview. That's my thesis. That's why I think this crypto winter could last very easily another 12 months. That would put us into this crypto winter for 18 to 24 months, depending on how long this could drag itself out and how close it gets to the next Bitcoin halving cycle. Be very, very cautious, and just remember that bear market bounces are often sucker traps. They call them bear traps for a reason. Be careful not to FOMO in buying back into these markets in the near term. All these macro headwinds that we've talked about, interest rates, quantitative tightening, the Fed rolling off its balance sheet, real estate headed, kind of downwards in terms of value. We've got, the stock market that's now in cyclical bear market territory. We have unemployment that's likely to go up. We have inflation at a 41-year high. These things take time to work out. You don't need to fear missing out on the next up move in the markets. Thanks for watching this awesome collaboration between Bar Chart and Savant Report. You can visit us at savantreport.com, sign up for our free newsletter. Also in the description of this video is a link to the Savant Report YouTube channel and my Twitter handle at Jordan Wirsz. Thanks for watching, and we'll see you again next time. Take care, everyone. Bye-bye.